When you understand how mortgage approval really works, the entire home buying process becomes much smoother. Most buyers focus on income and credit score, which absolutely matter. But there are several other factors that lenders evaluate that people don't always think about. And when you know what those factors are ahead of time, you move forward strategically instead of reactively. And you avoid some pitfalls that could cause you to not be able to qualify for a loan. Mortgage approval isn't about perfection. It's about documentation, stability, and predictability. So today, we're walking through several things that can affect a mortgage approval and how understanding them early puts you in a stronger position. Let's start with one of the most important ones, self-employment. Business owners are approved every day. The key difference is how income is calculated. When you're a W-2 employee, lenders look at your gross income and they verify your employment. But when you're self-employed, lenders typically review 2 full years of tax returns and focus on your net income, not your gross revenue. This is where clarity becomes powerful. If you're self-employed, you likely take deductions, mileage, equipment, marketing, office expenses, professional services. Those deductions reduce your taxable income, which is smart from a tax standpoint. However, they also reduce the income lenders use to determine qualifications. So your business may generate strong revenue, but if your tax return shows a lower net income after deductions, that's the number lenders work from. Understanding this ahead of time allows you to plan intentionally. If buying a home is on your radar within the next year or two, having a conversation with both your CPA and your lender early can help align tax planning and mortgage planning in a way that supports your goals. When planning happens early, options increase and stress reduces, and that's always a plus. Now let's talk about commission-based employment. If your income structure includes commission, bonuses, or performance pay, lenders look for consistency over time. They often average commission income over a 2-year period. That means if you recently transitioned from salary to commission, even if your income has increased, lenders may need time to establish that history. Predictability is what lenders are evaluating. When your income pattern shows stability over time, approval becomes much more straightforward. Understanding that timeline allows you to position yourself accordingly. Another important factor is length of time in your current role. Lenders look for stability within your field. Major career shifts, extended employment gaps, or sudden income structure changes may require additional documentation. When your employment story makes sense on paper, underwriting moves more efficiently. Clarity equals momentum. Now let's shift to credit. Beyond just your credit score, your credit matters, but so does how you use your credit. High credit card balances, recent new accounts, or increased debt can impact your debt-to-income ratio, even if your score remains strong. If buying a home is a near-term goal, approaching new debt thoughtfully can preserve your approval strength. Before opening a new account or financing something significant, ask yourself, will this support or complicate my home purchase in 6 months? That one question will protect your position. Another factor lenders evaluate is bank activity. They don't just review your balance, they review the source of funds. Large deposits require documentation. If money enters your account, there needs to be a clear paper trail. Gifts, transfers, business income, they're all workable, but documentation is essential. When deposits are documented clearly, underwriting remains smooth. Organization accelerates approval, which brings us to documentation overall. Mortgage approval is document-driven. W-2s, tax returns, bank statements, pay stubs, explanations for deposits. When these items are readily available and organized, the process moves efficiently. Prepared buyers experience less friction. Now let's also talk about reserves. Reserves are funds remaining after closing. Some loan programs require them, others do not. However, having reserves strengthens your file and demonstrates financial stability. From a lender's perspective, reserves show that you can manage unexpected expenses. From a homeowner's perspective, reserves create peace of mind. Home ownership works best when it enhances stability. Planning for breathing room supports long-term success. And if you're considering relocating to the Shreveport-Bossier area and you're trying to get a feel for the city from a distance, that can be challenging. I know that firsthand. So as a realtor, I've created a relocation guide just for you to help make your decisions more smooth and informed. And you can download that guide for free in the description. Now, back to this. Every situation we've discussed, self-employment, commission income, job transitions, credit usage, deposits, reserves, it's all workable. The key is communication. When you speak with a lender early and receive specific guidelines tailored to your situation, you gain clarity. A lender might say, let's wait 3 more months to strengthen commission history. Or let's adjust credit utilization before applying. Let's document this deposit properly. Let's review next year's tax strategy with home ownership in mind. These are strategic adjustments, and when addressed proactively, they position you for success. Now, if you're relocating, there's another important detail. Your mortgage officer must be licensed in the state where you're purchasing. If you're buying in Louisiana, your loan officer must be licensed in Louisiana. Working with someone familiar with Louisiana lending guidelines, insurance realities, and local underwriting expectations adds another layer of clarity to the process. It's also worth noting that local banks with in-house underwriting can sometimes provide flexibility. Large national lenders and local banks both close loans successfully. However, local institutions often have familiarity with regional income patterns and market dynamics that can be beneficial. Understanding your options increases leverage. Now, again, I'm a realtor, not a mortgage officer, but I do understand that your financial situation is what is going to make home ownership possible for you. So while I'm happy to provide this information, I will remind you that your best option is to reach out to your lender and have a one-on-one conversation with them, even if you're 6 months, even a year from moving, just to get an idea of what to expect when the time comes. If you don't have those options available to you, reach out to me and I'll be happy to connect you with someone who can guide you in the right direction. Now, if you're still undecided about buying a home right now because, like many other people, you are waiting patiently for those interest rates to drop, click here to watch this video where we explore that topic in detail.